Now this question builds on the previous one. It's the same, but I've just added one or two things. And that's what we're going to continue doing the whole time. So the things that I've already covered, guys, I'm not going to go into a lot of detail with it, otherwise this lecture will take forever. So this balance sheet is on the 31st of December. We had capital of 5 million, capital profits, revenue profits, a shareholders loan, and cash. Right, same as in the previous one. Number one says is the million rands. It says, or the 5 million. The capital, the 5 million rands represents shares of 1 rand each. 3 years ago, the company had a capitalization of 1 share for every 4 shares owned. Okay, so that means if I take that 5 million and I say 5 million divided by 4 plus 1 gives us 1 million shares. Okay, there's 1 million shares over there is the capitalization issue. So let me explain to you. There were previously 4 million shares. They then said for every 4 shares that you own, so, right, you'll get an extra share. So you'll get 1 million shares extra. That's basically what happened. So what I want you to understand about that 5 million over there is the following. It's split into 2 parts. 4 million rands of that is contributed tax capital, and 1 million rands of that is not. It was what? It was a capitalization issue. Right. So that has to be a reserve. It's not contributed tax capital. The rest of the capital profits and the revenue profits over there, guys, they are also reserves. Right. And the reserves here are subject to dividends tax. So, same story. Company was placed into liquidation, acquired it 10 years ago. Let's go. So first up, calculate what is the amount that will be distributed to shareholders and indicate what portion is a dividend and what portion is contributed tax capital. Right, so here's our contributed tax capital. Here is our dividend portion. Okay, so let's start with our opening balances. So the first one, our first balance is this capital amount, which is split 4 million for CTC and 1 million for reserve. So capital, you would obviously show your calculation. We're saving some time here. Capital, then we've got our capital profits and our revenue profits. Capital profits 2 million, revenue profits 1.5 million. Remember, it's not CTC. What is CTC, guys? The amount that you receive for the issuing of shares, not capital profits or anything weird like that. Don't get caught out because CTC means contributed tax capital. Don't think that's in capital. Right. So that's our opening balances. Then we say plus our accounting profit less our tax liability. Now, in this case, there's nothing strange and special happening in this question, so we don't do anything. 4 million and 4.5 million. This is available for distribution. Okay, so I'm going to make now I'm going to make a comment here. If the, let me actually do it as follows. This over here is the dividends tax. If shareholder, natural person, and if the shareholder or the beneficial owner is a South African company. Right. So if the shareholder was a natural person, you'd say 4.5 million times 20%, 900,000 rands. And if it's a shareholder as a company, it's none. Okay, I'm going to just use that in my example in a second. So we ask again at 3 and 4. Now, 4 says, what is the taxable income if it's a natural person? So here we're now going to calculate taxable income. As a quick reminder, we're looking at this over here. The dividend is a dividend, and the CTC is treated as if it's a proceeds on the disposal of a share. Okay, so what is the dividend amount? The dividend is 4.5 million. And that is exempt. We then have our return of capital or contributed tax capital portion, paragraph 77. Now this first part over here, guys, it's the same if it's a company or a natural person. Proceeds is our contributed tax capital of 4 million. They tell you in the question, purchase it for 6 million rands. Alright, purchase it for 6 million rands. So our base cost, 6 million. Now, that gives us a capital loss of 2 million rands. Now, we'll apply paragraph 19(1)(a), which says there is an exempt dividend if 100% exempt from income tax and 100% exempt from dividends tax. Okay, now, if it is a natural person, that's our first one we want to look at. If it's a natural person, is it 100% exempt from income tax? We look there, yes it is. Is it 100% exempt from dividends tax? If it's a natural person, no it's not. So does our exempt dividend equals null? So if you have a loss here, it says you can only claim amount that exceeds the exempt dividend per section 19(1)(a). What is our exempt dividend in this case? Null. So how much of the 2 million exceeds null? The full 2 million rands. So that full 2 million rands will be allowed as in our CGT column. That's if this is a natural person. If we now change this to a company, now we're looking at a company. Okay, very important. So we're looking at number 5 here. Okay, when we are doing it in a company, the first thing I want you to see is that the dividend portion will be exactly the same. Proceeds will be the same, base cost will be the same, capital loss will be the same. Now, when we get to this exempt dividend part over here, we'll say, was it 100% exempt from income tax? And the answer is yes, it was. Was it 100% exempt from dividends tax if it is paid to a company? The answer is yes, it is. So our exempt dividend is 4.5 million rands for paragraph 19. So we had a capital loss of 2 million. We can only claim the amount, the portion of the capital loss, which exceeds 4.5 million rands. So how much of the 2 million exceeds 4.5 million? Nothing. So nothing will be allowed. So can you see what SARS is saying? SARS is saying, if you didn't pay any taxes here, then you're not going to get the loss. But for the natural person, because the natural person did pay dividends tax, they can claim the loss. So SARS just doesn't want a situation where there's no tax being paid and you get the benefit of having a capital loss.